UiPath is a company that combines digital automation and artificial intelligence. It's no secret or it's no surprise that investors are interested in this company given all the enthusiasm for artificial intelligence in 2024. In this video, I'm going to conduct a discounted cash flow valuation of UiPath stock and answer what I think is a fair price to pay for UiPath. And I'll compare that against the current market price to determine if I feel the shares are undervalued at these levels. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, to make this discounted cash flow valuation, I need several inputs for my model, and three of those are the company's market cap at 7.65 billion, the cash and equivalents balance at 773 million, and the total long-term debt, which stands at 0. I also need the company's shares outstanding, which are 551 million. And I'm going to use Wall Street estimates for the company's free cash flow growth over the next 5 years, starting with 2024, which is already completed for UiPath, given its fiscal year ended in January 31st of 290 million, then increasing to 320 million in 2025, jumping to 360 million in 2026, up to 400 million in 2027, to 450 million in 2028, and 540 million in 2024. I also need the company's beta, which according to Yahoo Finance stands at 0.87. A beta of less than 1 means that the company's price movement should be lower than the S&P 500 index. If the S&P 500 index moves by 1%, UiPath stock should move by 0.87%. Now that we have all the inputs, I can share with you my valuation model for UiPath, and this is as of December 17th, 2024, starting with the free cash flow of 290 million for 2024. That's estimated to increase to 320 million in 2025, all the way up to 540 million by 2029. And these are all according to the Wall Street analysts that are following UiPath stock. From the year 2030 to 2034, I've applied a transition period growth rate for the company's free cash flows of 6.5%. The reason I chose 6.5% is because according to Wall Street analysts that are following UiPath stock, they expect the free cash flows from 2024 to 2029 to grow at a rate of 13.1%. And so from 2030 to 2034, I have the growth slowing down from the 13.1% to 6.5%. So half the rate of the next 5 years. And then from 2035 to infinity, I have the company's free cash flow growing at 5% to perpetuity. And that's because I feel the economies where UiPath operates, primarily in North America, I feel those economies are going to grow at a nominal rate of 5%. So I project UiPath will grow at the rate of the economy at 5%, nominal rate of growth. But these are all cash flows expected in the future. We want to know what the company is worth today. So we need to discount all of those cash flows back to today to incorporate both the riskiness of these future cash flows and the time value of money. Everyone would prefer to have money in their pocket today versus money in their pocket in the year 2030. So to discount those cash flows, I need a discount rate. And the weighted average cost of capital I'm going to use is 9.32%. I arrive at that number by applying a cost of debt of 7.5%, a capital asset pricing model, which comes to a cost of equity of 9.42%. When I apply a beta of 0.87, a risk-free rate of 4.2%, and a market risk premium of 6%. The company has a market cap of 7.65 billion with zero debt, but I'm going to assume that eventually the company will want to take on some debt because, as you notice, the cost of debt is lower than the cost of equity. Most companies, when they grow larger, even if they don't need debt, they take on debt because the cost of debt is lower. And so I'm applying a 5% capital structure for debt and 95% equity. So when I apply that discount rate to all of the company's future cash flows, I get a value of its operations between now and infinity at $10.5 billion, the present value of all those cash flows. Now, to that total of operations, we need to add the company's cash balance, which was $773 million, and then we need to subtract the debt, which was zero. The number of shares outstanding for this company was 551 million. So we take the value of equity of 11.3 billion, divide the number of shares to get an intrinsic value per share for UiPath stock at $20.54. Now the current market price is $13.91, which suggests that according to my calculation, UiPath stock is undervalued. But remember, I used several estimates and assumptions to make this conclusion, so there's still significant risk associated with these calculations. Still, according to the numbers available to me, I find this to be undervalued. That doesn't mean that the stock price will ever reach my intrinsic value per share. The stock could remain undervalued for a very long time. There are certainly several stocks that I felt have been overvalued, and they've remained overvalued and even gotten more overvalued throughout 2024. Still, for the most part, for the long term, I expect that these stocks will trade towards these intrinsic values per share that I've calculated. And these are the fair prices that I feel these shares are worth. So for me, going out and buying the shares at $14, I would feel like I'm getting a good price to accumulate UiPath stock. Remember, this is for informational and educational purposes only. Please conduct more due diligence before making any decisions on any of these stocks that I'm covering. Of course, I have dozens and dozens of videos on UiPath stock. So if you want to know more about this company, I encourage you to watch more of those videos before making a decision one way or another on UiPath stock. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.